Okay guys, here's our third video, and this is working 4. Again, I think these workings, just doing them like that, working 1, working 2, working 3, working 4 means you cover everything. And this is the non-controlling interest. So now you know the non-controlling interest, you know what it's worth at the beginning of the year, we're told, if you like. So the fair value at the beginning, if you like, of the year, let me just go back to working 3. Here we are. Here's the fair value at the beginning, 56,000. We know that, and we know that anything that really, because this is the value, isn't it? So we're just adding on any profit allocated to the non-controlling interest and taking off any goodwill depreciation, if you like, or goodwill impairment. Right. So we start off with the 56,000. We know that that's given to us from working 3. Then we need to go back to working 2 to find out, well, what's the share of the, let's just go back there. So here we are. Here's the 12,400. What's the share? What's their share of this? What's their 10% share? Right? Because they are non-controlling interest. So we have 10% of that plus 10% of 12,400, which is 1240. So 1.24 million. Right, so that's come, of course, from working 2. This has come from working 2. And then, of course, there's the impairment. They also share in the impairment, right? And working 5 will see the parent company's share of the impairment. So the share of the impairment, if you like, is 10%, if you like, of the full impairment, and that, if you like, 100, which brings us down to 57,140. 57,140, and that's working 4, and that's working 4, and that's good. Then we can look at working 5. Now, working 5, before we look at working 5, let's just see what else. There was something, a little note here about this thing. Parker had a small number of shares, 97, currently included at cost, and they've gone up by 2 million. That's literally it. Debit investment, 2 million. Credit, if you like, working 5, retained earnings, 2 million. That's literally all that's taken place with this one. So for working 5, what I want to try and do is I'll start off again. Literally working 5 is just saying, well, what are their own retained earnings? We are told, we can see their, if we go here, we can see the retained earnings right there, 100. 158, 800, 158 million. Then, of course, their percentage, 90% of 12,400, which is from working 2, and that comes out at 11,160. Then, of course, you will have the impairment. They have 90% of that impairment, which is 900, of course. And there's that fair value gain that I've just talked about, and that was 2 million. And this all comes to 171 and 60. So really, if we didn't have to prepare the statement of profit or loss, we would be done. But that's all. Working 1, and then like I said, my working 6 was my pup. Right? My working 6 was my pup, and I've dealt with that, haven't I? Here. So that's working 1 to 6. So let's quickly kind of look at the income statement. Now, remember, like I said, any sales between both parties needs to be eliminated. It says that you sold 48 million during the year, but it says that you only acquired them, if you like, in the last 5 months. We're only interested in revenue. We should only be excluding 5 months of this revenue, because prior to acquisition, that was fine. We could buy and sell from these people. We didn't own them. So that's fine. But because you only you now own them 5 months of the year, you now have, if you like, 5 over 12 times 48 million, which 5 divided by 12 times 48 million brings you to 20 million. So we must get rid, if you like. So we're basically debiting revenue with 20 million, and this is the revenue. This is the so-called, this was that transaction that that Scott had put through, needs to get rid of, and credit, if you like, purchases with 20 million, because this is the purchase from Packer. So you can see that, so this is Scott technically, and this is Packer. I mean, because they're coming together, of course, the 20 comes out of both when we add them. When I say add them together, it comes out. We'll see, I'll do that in a second. And that's that, of course. So it means that when I come to this thing called the consolidated statement of profit and loss, if you like, let's just go to that here. And when I come to that now, I literally will, right, with my revenue, I'll take my two revenue figures from the given to us, and if you look in the question, you see 385, 200. Now, like I said, what we have to be careful is you only own Scott for 5 months of the year, so you have to apportion literally everything going down that way. So you have 234 900 times 5 over 12, right? That's all you'd have, if you like, as you can imagine, and then you need to take away the 20,000. That's us. And this revenue really is coming out of, it's really coming out of this, as opposed to the cost of sales. When I deduct the 20,000, that's really coming out of Packer, really, but it's coming out. I mean, I am adding them together, but it's coming out of Packer. Now, the cost of sales here, again, like, if you like, you could do a working for it. I mean, I suggest that. I think that's a good way to do it, because it means that you sort of keep everything and nothing gets lost. So Packer has 212, and then of course, 212 000. Excuse me. And then we add on 5/12 of Scott, which is 76,560. And then, of course, so two things. We need to take off the 20,000. We've done that here. And of course, if you remember, we now have, like I said, this closing inventory of Packer. Really, Packer has closing inventory here that's inflated by 1.2 million. We discussed this at the beginning earlier on. So this, if you like, has to come. So literally, it's credit closing inventory, which in effect increases cost of sales, right? So in effect, I need to add the 1.2 million to all of this, really, to increase the, if you like, to increase the cost of sales, because it's coming off the closing inventory. So by it coming off the closing inventory, it's increasing the cost of sales. And that's it. Now, what they've also done in this question is to deal with depreciation in cost of sales, which kind of makes sense, because that's an additional. Typically, that's where you would put it, really, that depreciation, that expense of depreciation, and that would come in under cost of sales, and then you're done, and you should have, by the time you adjust, so 21,212 plus 76,560 plus 625 minus that. Plus the 1.2 million takes you to 225,725, and that's it. So I think that that's really the core of what's going on. I think by now, looking at this now, you should be comfortable with looking through the answers. I've done, I think, the key workings for you to be able to look and deal with this question. And if you have any other questions, we can talk about it on Friday. Okay, great stuff. Cheers.